Every time you swipe a card, take a loan, or deposit cash, you are part of a system that has been shaping human civilization for thousands of years. But how did banking begin? Why do central banks today, like the Federal Reserve or the European Central Bank, hold such incredible power over our lives, our businesses, and even the rise and fall of nations? This is the story of the banking system, an institution that began with grain stored in ancient temples, grew into the great banking houses of Europe, and transformed into global central banks that decide the fate of economies. Today, we will journey through history from Mesopotamia to Wall Street, from the Medici family to the Federal Reserve, from gold coins to digital currencies. This is the history of banking systems. In the cradle of civilization, the seeds of banking were planted in ancient Mesopotamia, where people recorded their loans and debts on clay tablets. As societies evolved, so did the need for more complex financial systems, leading to the rise of powerful banking families like the Medici. Their legacy pushed banking into the Renaissance, shaping modern economic practices. Fast forward to the 20th century, the establishment of central banks, such as the Federal Reserve, marked a turning point, centralizing monetary policy and lending authority. Today, these institutions hold tremendous sway over global economies, making decisions that reverberate across nations, influencing everything from interest rates to international trade. Rome too had its bankers known as Argentarii. They acted as intermediaries in trade, issued credit, and even operated rudimentary checking accounts. Our story begins in ancient Mesopotamia, nearly 4,000 years ago, in the bustling city of Babylon. Temples were not just places of worship, they were also the first vaults. Farmers deposited grain into temple storehouses, merchants left silver and gold for safekeeping, and priests acted as trusted guardians. Transactions were carefully recorded on clay tablets which functioned as receipts. These were the world's earliest bank records across the Mediterranean. In ancient Greece, banking took another form. Wealthy merchants and moneylenders offered loans at interest, financing trade ships that carried olive oil, wine, and pottery across the seas. In Athens, bankers were known as trapezitai, named after the trapeza, or tables on which they conducted business. They accepted deposits, changed money, and financed voyages. Roman banking was advanced for its time, but heavily tied to the fortunes of the empire. When Rome collapsed, its financial system crumbled as well. Meanwhile, in the East, India and China were developing their own systems. In India, merchants used a financial instrument called the hundi, a written order, promising payment that made long-distance trade safer and faster. In China, moneylenders and traders pioneered paper notes and promissory certificates centuries before Europe would adopt similar practices. Across these civilizations, the seeds of banking were being sown. But the story of modern banking truly began in medieval Europe, where money, power, and faith intertwined in surprising ways. Meanwhile, Venice became the banking hub of Mediterranean trade. The fall of Rome left Europe fragmented, but trade never disappeared as merchants traveled across Europe. New centers of finance emerged, especially in the Italian city-states of Florence, Venice, and Genoa. In these bustling cities, merchant families created the first great banking dynasties. None were more famous than the Medici of Florence. Beginning in the 14th century, the Medici built a financial empire that stretched across Europe, financing monarchs' trade and even the Catholic Church. The Medici also pioneered accounting innovations. They perfected double-entry bookkeeping, a system where every debit had a credit that remains the backbone of accounting today. With this system, their bankers could track complex networks of loans, investments, and repayments with unprecedented accuracy. By the late Middle Ages, European banking houses had become powerful enough to influence politics and wars. Monarchs turned to bankers when they needed funds for crusades or conflicts. In return, bankers gained privileges, influence, and wealth. This marriage of money and power laid the foundation for modern banking. And as Europe entered the age of exploration, banking would expand even further. Financing the voyages that connected the old world and the new, the 1600s marked a turning point in banking history. Trade was expanding rapidly, colonies were being established, and governments needed more money than ever before. But merchants and monarchs needed banks that were stronger and more reliable than family-run houses. In 1609, the city of Amsterdam created the Amsterdam Exchange Bank. It was one of the first true public banks, and it quickly became a trusted place for merchants to deposit money and settle international transactions. Its success made Amsterdam the financial capital of Europe in the 17th century. In 1694, the Bank of England was founded, not just as a commercial bank, but as a lender to the government to fund wars against France. The British Crown borrowed from the bank, which in return received the right to issue banknotes. These notes were promises to pay the bearer in gold or silver. Paper money began replacing heavy coins in everyday transactions. Promissory notes and bills of exchange spread across Europe, allowing merchants to trade across vast distances without physically moving. Gold banks also played a critical role in colonial expansion. They financed trading companies like the British East India Company and the Dutch East India Company, which became among the most powerful corporations in history. Banks, governments, and trade formed a triangle of power that reshaped the world. Modern banking, as we recognize it today, had been born. But with greater power came the need for greater stability, and that led to the creation of central banks. Why were central banks created? The answer lies in stability. Throughout the 18th and 19th centuries, financial crises were common. War, speculation, and sudden panics could bankrupt merchants, ruin banks, and even destabilize governments. To prevent chaos, nations needed a financial anchor. The Bank of England became the model. It issued banknotes that were trusted, regulated interest rates, and acted as a lender of last resort during crises. Other countries followed, establishing central banks across Europe. Sweden, France, and later Germany. Central banks were not only stabilizers, they were engines of industrialization. As railways, factories, and new technologies spread, these massive projects required credit. Central banks ensured that governments and businesses had access to the money needed for expansion. But as economies grew more complex, so did the challenges. By the dawn of the 20th century, the world needed a new central bank to stabilize the most rapidly growing economy of all the United States. In the late 19th and early 20th centuries, America's banking system was chaotic. Hundreds of banks issued their own notes, and financial panics regularly swept through the country. The most famous was the Panic of 1907, when markets collapsed, banks failed, and the entire economy nearly fell apart. This crisis convinced lawmakers that the United States needed a central bank. In 1913, Congress created the Federal Reserve. Its mission was to provide stability by controlling the money supply, setting interest rates. In 1944, a new system was born, the Bretton Woods Agreement. Under it, the United States dollar became the world's reserve currency pegged to gold, while other currencies were pegged to the dollar. This system lasted until 1971, when President Richard Nixon ended the dollar's link to gold. From then on, money was no longer tied to metal. It was based purely on government trust. This system of fiat money remains the backbone of the global economy today. But the story of modern banking would be incomplete without looking at the crises that shook it to its core. As the world embraced this new monetary system, the inevitable crises began to emerge. The Great Depression left millions in despair, followed by the 2008 financial meltdown that shook economies worldwide. Each crisis revealed cracks in the foundation of trust and stability, pushing governments and institutions to adapt or face collapse. The lessons learned from these tumultuous times shaped modern banking practices and policies, forever altering the landscape of finance. After World War II, global banking expanded rapidly, marked by the creation of international institutions like the International Monetary Fund and the World Bank, aimed at stabilizing economies and promoting development. Stock markets boomed, banks expanded worldwide, and credit became central to modern life, shaping how individuals and businesses managed their finances. But banking has always walked a fine line between stability and collapse, as the Great Depression had shown how fragile the system could be. In the 1970s, oil shocks and inflation tested the limits of central banks, while the 80s and 90s saw debt crises strike countries from Latin America to Asia, and in 2008 the world faced the most severe financial crisis since the Great Depression, shaking the foundations of global banking once more. In the aftermath, discussions arose about reforming banking systems to ensure stability while individuals adapted to an ever-evolving financial landscape. With innovation at the forefront, fintech startups emerged, revolutionizing the way people interacted with their banks and accessed financial services. Triggered by risky mortgage lending and complex financial instruments, the crisis brought banks like Lehman Brothers to collapse and nearly froze the global economy. Central banks responded with unprecedented actions, bailouts, money printing, and a policy called quantitative easing. The 2008 crisis showed just how interconnected global banking had become. A collapse in one part of the system could ripple across the entire world. It also reminded us that banking at its heart is built on trust, and when that trust breaks, the system can fall apart. As the financial turmoil escalated, central banks convened in urgent meetings, crafting strategies to stabilize the economy. In the streets, the public voiced their outrage and disappointment, feeling the impact of decisions made far above them. The world watched closely, aware that every action taken could lead to recovery or further despair. So where is banking headed next? In the 21st century, digital technology is reshaping money once again. Online banking, mobile payments, and digital wallets have made money more fluid than ever before. Cryptocurrencies like Bitcoin have challenged the monopoly of central banks, offering a vision of decentralized finance outside government control. At the same time, central banks themselves are experimenting with digital currencies. The future may see central bank digital money replacing cash altogether. But at its core, banking is not just about coins, paper, or even numbers on a screen. It is about trust. From clay tablets in Babylon to blockchain ledgers. Today, banking has always been the invisible engine of civilization, moving resources, financing dreams, and shaping the destiny of nations. The question is, in a world of digital revolutions, can banking continue to hold that trust, or will a new system take its place? The history of banking is the history of us, our trade, our ambitions, our wars, and our hopes. It is a story of temples, goldsmiths, dynasties, central banks, and digital futures. And as long as humans need to exchange value, the story of banking will continue to evolve.